Hey, Emmett Dempsey with Treasure Coast Mortgage here in Florida. Welcome back to the channel. Today's video is on about how to buy a house with a lot of student loan debt and how that affects your ability to buy or refinance your house. Now, you may be a first-time home buyer who recently graduated and all your loans are in deferment, or even a move-up buyer or a current homeowner and your loans are deferred or income-based repayment plans. Truth be told, myself and my wife, we still have our student loans many years after college, but we're aggressively attacking them now, but it's just we still have student loan debt that we have to account for. But even after 2020 and COVID and job losses, many people opted to put their loans in deferment or go on an income-based repayment plan, and that's fine. But you have to account for that. Now, the reason why that's an issue is that even though your payment is zero, we still have to account for a payment, even though it's in deferment. Even though you may be paying zero for now and paying more later, we have to account for that. And it affects you because that payment lessens how much home you can buy. So how do we come up with that? Because when I first started doing loans, back in 2007, it was student loans were deferred and it was just move along and it's zero. Well, it's not that way anymore. So how do we account for that? It all depends on the loan type. And I'm going to go over the major loan types, your Fannie Mae, Freddie Mac, or your conventional loans, also your FHA and VAs, and how we account for them. Okay, number one, Fannie Mae. Fannie Mae uses a 1% standard. So basically, if you owe $100,000, I have to count $1,000 a month. And the credit report, of course, is what we take. So whatever the payment is on your credit report, that's what Fannie Mae will accept. If it shows zero, we have to prove it's an income-based repayment plan. So Fannie Mae will accept from your student loan servicer. If it's an income-based repayment plan, they'll accept that payment at zero, or they'll accept what's on the credit report. And if those two are not available, they'll use 1% of the balance. Number two, Freddie Mac. They use a similar standard, but instead of 1%, they use 0.5%. So that can be a very big factor because it's cut in half. So if you're a conventional borrower and you're not in income-based repayment and you're just in plain deferment, that really helps. We can go to Freddie Mac, and then that would cut your payment in half. So you owe $100,000. Instead of $1,000, it's $500, and that could be the difference in you qualifying or not, or buying more of a house. Number three, FHA loans. FHA for years and years has been 1%, hard and fast. No matter what is on your credit report, if it's less than 1%, too bad, so sad, got to use 1%. So that really affects a lot of FHA buyers from qualifying because you had to use 1% no matter what. And there are some recent changes by the Biden administration. You may have heard about it, student loan changes, where they allow, number one, to use what's on the credit report. If it's greater than zero, they'll accept whatever's on your credit report, which is huge. But if it is at zero and income-based repayment, they'll use 0.5%. So it's not as good as the Freddie Mac guideline, but it's pretty similar, and it's much better than what it has been in recent years. Number four, VA loans. VA is something near and dear to my heart. I'm a veteran myself. I love helping veterans with their home loans. VA uses a unique standard. Generally, if it's deferred for more than 12 months, they'll ignore it. Okay, so if your house is deferred, your student loans are deferred for over 12 months, they'll ignore the payment. But if you're deferred for less than 12 months, what VA does is they do a threshold payment. And a lot of times it's less than the Fannie Mae and Freddie Mac. What they do is they look at your student loan balance and they times by 5% divided by 12, which is the threshold payment. Okay, so for say that for a $100,000 example, times 5%, it's $5,000 divided by 12, it's like $416.67 a month. Okay, so that's the payment that they would use. Now, if your payment is below that, then they need an explanation as to why. So you could still be an income-based repayment. They just have to get an explanation from the servicer. But if you're in one of those situations where you're not income-based repayment and it's just deferment, that's what they would use is $416.67. But just rule of thumb on Fannie Mae it would be 1%, and Freddie Mac at 0.5%. Those are still bigger than in VA. VA definitely has the best guideline. Well, that's in a nutshell. That's how student loans will affect your mortgage qualification. Of course, here's some more videos on my channel that might be useful to you. Of course, if you're looking to buy, sell, refinance, definitely give me a call. Go to DempseyMortgage.com. Thank you so much for watching, and I'll see you on the next one.